So one of the stories that I wanted to cover was a lot of people are talking about Silicon Valley Bank. I was questioning whether I was going to cover this subject because there's a lot of people that are talking about it. But on top of a lot of people talking about it, there are people who I have a lot of respect for that have covered it thoroughly. And I was like, is it really worth me covering? But then there are some new developments that have come about, right? That I can cover, right? And so, first off, to get what's going on in Silicon Valley banks, let's go to this article that explains what in the hell happened. Okay, because I was confused. I was like, what in the hell is going on? And really, if you go back in your mind to 2008, right? During the financial collapse, what happened? Well, basically, the stock market is basically like a big ass casino. And so they make bets. They lost on some of those bets, and they were a little too trigger happy when it came to those bets. And they lost big. They lost really big. And on top of it, they were talking a bunch of people who actually couldn't afford a home into getting a home, particularly a lot of black people. And so a lot of people defaulted. And so since a lot of people defaulted, then those banks, well, that money wasn't coming in. So guess what? They defaulted. And so that caused a huge financial collapse, which Bush and Obama basically saved the financial sector, the stock market, basically. But they didn't save average people like you or me. So that's what caused a gigantic collapse. Now we are seeing the second biggest bank collapse in U.S. history. Let's get into it. So what you need to know about the collapse of SVB and Signature. So Signature Bank also collapsed as well. It says over and over again, we find this essential truth. Once banking was deregulated, the next crash becomes inevitable. Now, this is an article by Robert Reich, former labor secretary under Clinton, I think. Now, while I don't think Robert Reich has that much room to talk, he does give some of the facts of what's going on here, which is good. So we have to take the grains of truth, where we can find them. And he kind of circles around what really is the problem, but he doesn't necessarily pinpoint exactly what the problem is. But that's what I'm here for. I'm going to do it. So let's get into it. So it says on Friday, bank regulators closed Silicon Valley Bank, based in Santa Clara, California. Its failure was the second largest in U.S. history and the largest since the financial crisis of 2008. On Sunday, regulators closed New York-based Signature Bank. As they rushed to contain fallout, officials at the Federal Reserve, Treasury, and Federal Deposit Insurance Corporation, also known as the FDIC, announced a joint statement on Sunday that depositors in Silicon Valley Bank will have access to all of their money starting Monday. They'd enact a similar program for Signature Bank. So he goes on and says the surface story of the Silicon Valley Bank debacle is straightforward. During the pandemic, startups and technology companies enjoyed hefty profits, some of which they deposited in the Silicon Valley Bank. Flush with cash, the bank did what banks do. It kept a fraction on hand, which that fraction on hand is basically when you make withdrawals, they have that money on hand. So then they give that to you. Like, let's say you're at Silicon Valley Bank and you want to withdraw $200 because, I don't know, you have some bill you have to pay. And so they have that money on hand to give you to withdraw. So on their balance, they have that, but what they do is the rest of that money, they take that money and they invest it. And that money goes to investment and it grows. And then whatever they make off that investment, they keep the profits. And then the money is back in your account. Right? So they have that money on hand. They're supposed to have that money on hand for your account. But they also invest that money, some of that money, and then make money off of your money. That's what banks do. That's how they make money, right? So they just don't, a bank just isn't holding your money. They're investing the money that's in there and then making profit off of the money that's in there. Off that pool of money between you and all the other members in that bank, all the other account holders. So, right? I'm not that good at finance, but that much I understand. Okay. So, and I'm not that smart when it comes to this stuff. So this is why articles like this are helpful. Okay. So let's get back into it. So it kept a fraction on hand and invested the rest, putting a large share into long-dated treasury bonds that promised good returns when interest rates were low. Now, he continues, but then, starting a little more than a year ago, the Fed raised interest rates from near zero to over 4.5%. As a result, two things happened. The value of Silicon Valley Bank's holdings of treasury bonds plummeted because newer bonds paid more interest. And as interest rates rose, the gusher of venture capital funding to startup and tech companies slowed because venture funds had to pay more to borrow money. As a result, the startup and tech companies had to withdraw more of their money from the bank to meet the payrolls and other expenses. But the bank didn't have enough money on hand. So, says in 1930s, bank runs were common, but Roosevelt administration enacted laws and regulations requiring banks to have more money on hand, barring them from investing their depositors' money for profit. It is the Glass-Steagall Act, ensuring deposits and tightly overseeing the banks. Banking become more secure and boring. And so, he said that lasted until the 1980s. So what they did was they repealed Glass-Steagall, culminating in 1999 when Bill Clinton repealed it in Congress. So then, in the 2008 financial crisis, and remember what Professor Richard Wolff always says? He says that a recession happens every 4 to 7 years, right? So you got 1999, 2008. Glass-Steagall gets repealed, 2008. Guess what? 9 years. So 9 years, which is a little bit overdue. 4 to 7 years, we usually typically have a recession. That being said, it was overdue, and the more overdue it is, the harder the fall it has, right? That's like me having my phone, and every 4 to 7 years, it falls off this, that far. Every 4 to 7 years. But the longer it stays off, the higher the altitude it goes, and the longer the drop it has. And so because of that, because of the system that we have, the bigger they are, the harder they fall. Right? So because of the repeal of Glass-Steagall, they got greedy. Because capitalism facilitates and exacerbates greed. It allows for greed to happen. Remember what Gordon Gekko said, greed, for a lack of a better term, is good. So guess what? They did it, especially with the repeal and under Reagan, because Reagan wanted to deregulate the hell out of everything. Guess what? Bill Clinton was the same. He deregulated a bunch of stuff. So guess what? They started to repeal even more and more and more. Right? So then, of course, came the 2008 financial crisis, the worst collapse since 1929. It was the direct result of financial deregulation. Alan Greenspan, chairman of the Federal Reserve from 87 to 06, called it a once-in-a-century credit tsunami. But pressed by critics, Greenspan acknowledged that the crisis had forced them to rethink his free market ideology. He said, "I have found a flaw," he told a congressional committee. "I made a mistake. I was shocked." Shocked! Shocked! I'm shocked. I couldn't believe capitalism isn't perfect. Oh my God, the free market. A bunch of people could have told you that. Isn't it funny how Alan Greenspan looks a lot like Rupert Murdoch? Just a quick thought. Anyways, but shocked, appalled. So let's go down to this piece. Because they put in Dodd-Frank. It says the Obama administration rescued Wall Street, but enormous cost to taxpayers and the economy. Estimates true of the cost of the bailout vary from $500 billion to several trillion. The Federal Reserve also provided huge subsidies to the big banks in the form of virtually free loans. But homeowners whose homes were suddenly worth less than the mortgages who owned them were left hanging in the wind. Many lost their homes. This is why a lot of Black people end up losing wealth in the economy, because Black wealth tanked under Obama because he favored the banks instead of working people. Says Obama thereby shifted the cost of the bankers' speculative binge onto ordinary Americans, deepening mistrust of the political system, increasingly seen as rigged in favor of the rich and powerful. Because Obama is basically one of their goons, which somebody like Robert Reich should know better, especially since his boss, Bill Clinton, was also another one of those goons. But anyways, package of regulations put in place after the financial crisis, called Dodd-Frank, made by Chris Dodd and Barney Frank, was not nearly as strict as banking laws and regulations in the 1930s. It required that the banks submit to stress tests by the Fed to hold a certain minimum amount of cash in your balance sheet for protection against against shocks. But it didn't prohibit banks from gambling with their investors' money, because Wall Street lobbyists backed with generous campaign donations from Wall Street wouldn't have it. So what does that mean? They basically told their flunkies in the federal government, look, don't do this. In fact, we will make sure that you are employed forever until you die, basically. So do not regulate us. So guess what? And that's what they did. They did the bidding of the rich. Right? Privatize the gains, socialize the losses. So, the gains, they get it all, but who gets left holding the pile of doo-doo out of their, that they put out there? Us. That's who gets left holding it. Okay. So that's what happened, right? And even though Dodd-Frank was in place, it was rolled back just a little bit of it. Whatever, it just is weak. compared to Glass-Steagall was rolled back by Donald Trump, who in 2018 signed a bill that would reduce scrutiny over many regional banks and remove the requirement which bank assets under $250 billion submit to stress testing and reduce the amount of cash they had to keep on their balance sheets to protect against shock. Basically, it was the parameters were $50 billion and up, right? So if you had $50 billion in assets, then you had to submit to stress test, and you guys had to have a certain amount on hand. But what they did was they raised the parameters, right? Not raised, but they reduced the parameters. So you can be a smaller bank and not have to be subject to these type of stress tests to make sure that things like this don't happen. So now it's only for the really big banks. So the smaller banks can do this stupid BS, and guess what? They now put a bunch of people still at risk. Said this frees smaller banks such as Silicon Valley Bank and Citadel Bank to invest more of their deposits to make more money for their shareholders and their CEOs, who pay is linked to profits. There it is. Whoop, there it is. That's what it is. It's linked to profits. Guess what? That means that they're making money off of money. And so because of that, then it's all about profit centered. This is capitalism, people. This is how it works. And so because they're making this up all for profits, who gets left holding the shit sandwich? Basically you and I, right? And some small business owners, some small tech companies, what have you. And so for us, guess what? If you're in East Palestine, or if you're in Jackson, Mississippi, or Flint, Michigan, or if your food stamps got cut, or if you're trying to cancel your student debt or your medical debt, or if you're trying to get health care for everybody, got some bad news for you. Now, this is just, gosh, this is some bullshit. That Silicon Valley Bank's chief executive Ray Becker had been a strong supporter of Trump's rollback. Becker has served on the San Francisco Fed's board of directors. Of course! But here's the kicker. Becker, who is the CEO of Silicon Valley Bank, sold $3.6 million of Silicon Valley Bank stock under a trading plan less than 2 weeks before the firm disclosed extension losses that led to its failure. There's nothing illegal about corporate trading plans like the one Becker used, and the timing could merely have been coincidental, but it smells awful. So he knew something was happening. He smelled the smoke. He knew there was a fire close by. And so guess what? He decided to dip. But before that, he sold all his stock off. So he knew 2 weeks before all y'all did. And he made out like a bandit. Oh boy. So that's what's going on. Now, recently, some stuff happened. So now what they're doing is they are going to be guaranteeing deposits. Now, let me share my screen. And shout out to Case Study QB, always doing the damn thing. Case posted this clip, and it says, summarizing what President Biden said after Silicon Valley Bank collapse. What we effectively have done is guaranteed deposits across the country. You could say de facto nationalize the banks. That has a lot of ramifications. Let's get into it.
President Joe Biden assuring Americans and businesses that they're going to be able to pay their workers, and assuring Americans they're going to be able to pay their bills. They also talked about the actions that Janet Yellen took this weekend. Wanted to make sure that all customers would be protected and have access to their money. No losses will be borne out by the taxpayers, the president assured us. Also, the managers of the banks that were taken over will all be fired. The president also, his third point was that investors would not be protected. Those who invested in these banks would lose their money. He said that's how capitalism works. He said no one is above the law. If any laws were broken, those people will be brought to justice. It's also going to be calling for Congress to strengthen rules for banks, and made reference to some parts of Dodd-Frank that were, in his words, weakened over the past administration by Donald Trump. Of course, Wall Street Journal editorial page today disputed that fact, said that wasn't the cause of this past weekend. But the President of the United States saying at the end that Americans can rest assured that their money is safe. Let's bring in right now co-anchor of CNBC Squawk Box, Andrew Ross Sorkin, and ask you, Andrew, what did you hear there from the president?
Well, I think that he was trying to reassure Americans to keep their money effectively where it is, so there's not additional bank runs around the country at small banks. I think one of the things we saw happening over the weekend was the big banks, the JP Morgans and Bank of Americas, were getting phone calls saying, can I open an account immediately? This effort is aimed at that. What we've effectively done, though, is guaranteed deposits across the country. You could say de facto nationalized the banks. That has lots of ramifications. And I should say, while the good news is that hopefully this stems the tide, there's a real question about what the economic cost of this is going to be more broadly. The stock market this morning looks like it's going to open down. Why? In part because these small banks, which historically we didn't think were systemically important, now are, which means that they're going to be regulated. They're going to have higher costs, a higher capital cost. That means that loans to consumers and businesses are going to go up. That's going to cost the economy. So this is not over yet. And there's a big debate as to what it really means for the banking system, and also who was the beneficiary. These are not bailouts like 2008, but I'll tell you, the venture capital community in California, they were bailed out big time this weekend.
You know, it should be illegal for them to play with people's money like that. Imagine being an account holder at Silicon Valley Bank, just a regular account holder. You got your checkings, you got your savings, that's it, right? And let's say you just got your paycheck and you're about to pay some bills. You got to pay some bills. And you go to Silicon Valley Bank to withdraw, or you go to the ATM to withdraw, and you can't withdraw your money. Imagine that sinking feeling you must have. So, yeah, the FDIC had to come in and say, look, you guys will be able to withdraw all your money. If I were with Silicon Valley Bank, I would withdraw all my money and close my account. I'd be like, nah, I'm done with y'all. And don't think to go to these big banks, because they're no different. They're no different. It's crazy how people thought, oh well, they're smaller. Just because they're smaller, it doesn't mean much. But they're subject to the same risks too, and they can cause a systemic catastrophic failure. Look, I'll put it to you like this. Let's say you have a bunch of generators that are generating power to, let's say, a building. And some of the generators are bigger than others. You have some of the big, huge, gigantic diesel generators, all the way down to the itty bitty little gas power generators, right? And then you have some in between. You'll have maybe 4 or 5 big, huge, gigantic diesel generators. But then you have, about 100 medium-sized generators. And you have like 250 tiny generators, right? But if those 100 medium-sized generators, those smaller generators, and let's say 100 of those smaller generators were to fail, you don't think it wouldn't affect the system? It would. And because these banks are not subject to the scrutiny that was in place with Dodd-Frank, the very minuscule scrutiny that Dodd-Frank was in place, and the fact that that was repealed, then guess what? It happened. And so why did it happen? Because of their greed. Because they wanted to make more profit. Because capitalism is a system that requires infinite growth on a planet with finite resources. And people will be like, oh, it's just cronyism. No, capitalism by any other flavor is still capitalism. Just like chips by any other flavor is still potato chips. Suleiman says, hubby's employer put his retirement in stocks and he lost a buttload. He'll never be able to retire. Oh my God. Yeah, I was with a friend and he was looking at his 401k. He was looking at his 401k and he was worried. Worried that if things crashed, and guess what? His retirement, gone. Those years of saving, gone. Poof. Kiss it goodbye. Would we really have that much to worry about if healthcare, housing, education, if things like that were guaranteed as a right in this country? Would we really have to worry about retirement that much? Let's say hypothetically, food, housing, healthcare, and education. Let's say those four were guaranteed in this country. Let's say all four were guaranteed. You would never go homeless. You would never not have healthcare. You would never go hungry, and you would never not ever have education. Let's just say those four things. Would this be as big of a worry for you? Anyone? Yeah, I don't think so. Kelia Gregor says, yep, 401k is Gen X, there's pension. Yep. I remember back when I was in high school, they were teaching us about applying for jobs and things like that. And the guy who was teaching us about applying for jobs and stuff, he would say either a 401k or pension plan. And it's like pension plans aren't around anymore because they want that money for themselves. They'd rather just take that money and just put it in the stock market and let it be subject to the volatility of the market. But they would never, ever want to give you a pension plan because that means that they have less profit. So that was the first clip. So Biden is making sure that depositors are able to take their money out, or secure the money. But the question is, what about the CEOs and the investors? What about them? Well, somebody's upset because this guy was talking about, Andrew Sorkin said that, it's essentially a de facto nationalizing of the banks, which I personally say, good, let's nationalize the banks. Because if there's no profit motive, then guess what? They're not willing to put your money at risk. If they're not willing to put your money at risk, then guess what? Then people will not have to worry. Yep. And as Roger Meadows, typically, tells me, which is a good thing, is, national public banks, so that we're able to increase our infrastructure. But I also would like to see public banking, preferably postal banking, like we had back in, I think up to the 60s. I think we had postal banking. So you literally could go to the post office and bank there. You didn't have to go to a private bank in order to open an account. We used to have postal banking. I think we should have that again. But then guess what? If we had a postal banking system, they wouldn't be subject to all of the collapses that are happening because they would be backed by the federal government. And they wouldn't be so trigger happy to taking your money out of your account to invest it into this volatile system and then possibly losing. Now, okay. So CNN decided to interview this guy. Dear God. Kevin O'Leary. And he talks about the collapse. A capitalist. And he complains. Now, I'm okay with the tears of capitalists. I'm okay. But he's going to cry like a petulant baby. I can't stand it. But it's important to hear what he has to say because, well, it's just good to hear. All right, let's go.
What are you hoping to hear from President Biden?
Well, I think I know what he's going to say. I don't think he'll say it in the way I'm suggesting, but what effectively happened over the weekend is that he nationalized the American banking system. It's no longer a risk. It's no longer private in any sense. It is now backstopped by the government, ultimately the taxpayer. So it doesn't.
First off, number one, I would love if it was nationalized because that means that the risk is not there. Because why are we going to allow these financial institutions to put our money at risk? I don't think that's I don't think that's right. I don't think that's a good thing to do. Like, if somebody wants to do it personally, then, I mean, all right. But I just don't agree with private banks. I don't know. Maybe that's just me. But and by the way, I hate to put it this way, but anybody that calls themselves Mr. Wonderful is a pretentious bastard. Let's just be real. The amount of arrogance is sky high. Anyway, I just had to say that because this guy just rubs me the wrong way.
No matter how bad you are as a bank manager, and a good example is what happened at Silicon Valley Bank. That was a combination of a negligent board of directors and idiot management. That's a very powerful cocktail when put together, and it completely wiped out that bank. And that's what should have happened.
But if they have made a huge amount of money instead, would you be saying the same thing, Kevin O'Leary? Like, you're willing to poo-poo on all of the losses, but if they were to make a whole bunch of gains over it, people be damned, screwing people over, then you probably would have been like, oh, okay, cool. God damn.
We knew before the weekend started that every account with $250,000 or less was insured, and anything beyond that, which is generally business accounts or sophisticated investors, was not. But that's all changed. Now you have no risk in any bank anytime, and you as the taxpayer bear that going forward.
When we spoke on Friday, I said, how big a deal is this, Kevin? And we were texting, you said, next week the real trouble starts when they can't make payroll. Now it looks like they will be making payroll, I would imagine. So what do you think? Do you think that maybe the pressure is off now, that things are going to go back to normal, or is there still more fallout here?
No, they'll never go back to normal. Two things are going to happen. This quick move, this policy decision, was to try and stop a run on small banks, mid-sized banks. I don't think long-term that's going to work, because why would you take even 1% of risk keeping your money, or at least all of it, in a small regional bank? You're going to diversify. And I think that's the first lesson that wasn't being adhered to, is when you have liquid assets, you want to make sure it's diversified. And the rule we've put in place for our portfolio companies is no more than 20% in any one financial institution, because you never know where the black swan is swimming. In other words, every single institution has an idiot manager. Big ones, small ones, that's been proven by history. You just don't know where they are. And that's the same for every sector of the economy. But the banking system's different. We have 11 sectors in our economy. The banking system, financial services, is one of them. But it services all other 10. So what's really happening when the president steps out in a few moments is he's basically saying, look, I can't take this risk anymore. I'm just going to nationalize the whole thing. And that's the way we should look at banking going forward. Nothing more than highly regulated utilities. And that has profound impacts for you as an investor. If you thought putting your money into bank stocks was a good idea, you should change your mind this morning forever. And should you own bank bonds, you were taught that lesson over the weekend. If you owned equity in Silicon Valley Bank, it's worthless. If you own the bonds, it's
Kevin,
worthless.
I think.
Go ahead.
Sorry to interrupt, Kevin. I didn't differentiate between the small and medium-sized banks that were given more lax requirements in that 2018 legislation and the big guys, because the big guys closed up on Friday, and there's a flight to safety to JP Morgan, to Citigroup, et cetera. Mm-hmm.
That doesn't mean you should not assume that just because they're big, they can't fail. Managers make mistakes all the time. No, but
they are held to higher, but they are held to stress test requirements, higher capital and liquidity requirements because of Dodd-Frank. That didn't get diminished for those big ones.
And you should assume that stage is going to be lifted even higher on them. So they're going to be even more regulated as they become more concentrated and far less profitable. That's my point.
Far less profitable. See, the goal is profit. That's basically what it is. But the thing is that it's supposed to be the greater the risk, the greater the reward. But once that risk happens, if you fall, and guess what? It's going to be a huge fall, a great fall. And so because of greed in this capitalist system, which is inevitable, they will make bigger and bigger risks. They will continuously bet high because they want to make as much as possible. They're not going to bet small, even if the parameters of the gains are more higher. They're not going to do that. They're continuously betting. And it's not their own money, it's your money that they're doing. That's why a capitalist system does not work, because they're constantly making risks, and with risks come either reward or famine. And so guess what? Now federal dollars have to go in and shore up and protect the people, when in reality we shouldn't have had that in the first place. And now you got people like Kevin O'Leary that are pissed off at the fact that, people are getting shored up. Well, guess what? It was not the fault of somebody who has a checking or savings account. It's not their fault. And yet, he's like, well, they shouldn't have put in that risk. Well, maybe that risk shouldn't have been there in the first place. Maybe just maybe Glass-Steagall should have stayed in place. I go farther than Glass-Steagall. I say just nationalize all of it. But that's just me. Dear God.
That's my point. This really does make you think about owning bank stocks long term. I think they'll be underperforming the index for decades to come. That's my personal opinion. But it's the behavior of you as an investor in the actual accounts. If you're a business, you can't put it all in one financial institutions. Certainly everybody learned that lesson over the weekend. So diversification is going to matter. But this has fundamentally changed the way you should look at banking, because I'm not really comfortable that all of a sudden we've de-risked everybody all of the time. It was a good idea to de-risk $250,000 and make more sophisticated investors think about their behavior and how they should put their capital to work. Get diversity. You don't have to do that anymore, according to what the president is going to say. You have zero risk, and that has consequences. There's no such thing as a free lunch, and this is going to be very expensive for shareholders of banks long term.
All right.
I would never put my money into a bank stock ever again.
Oh, Kevin O'Leary. Kevin,
Yeah. Oh, boy. There was a point that I wanted to point out. Is it in here? It's not in there. But yeah, so there was an article that I was reading that was saying how a small percentage of our sector was finance. And because of a small percentage, I think it was like 10% of the sector was finance. And then once the repealing of these different laws happened, it raised it to like 40%, which is higher than manufacturing. And so that's the system that we have. It's wanting to make money off of money for the sake of making money, and profit's the name of the game. So that's it, man. And people sitting here, you know, thinking, oh, we just gotta regulate a little bit more. And really, look, every single time you try to put guardrails on capitalism, it shakes it off. And Kevin O'Leary's saying, oh, well, it's their fault that they put all this, you know, they did, you know, these risky bets. Thing is that capitalism is a beast that says you have to do more risky bets in order to make more profit, because you have to make more last year than you did the year before. You have to make more the last quarter than you did before. So fiscal year 2022 has to be, you know, fiscal year 2023 has to be more than fiscal year 2022. You have to do that. And if you don't, then guess what? Shareholders will not be happy. And if shareholders aren't happy, then guess what? They pull their money out. Because they want to do it, all they want to do is just make more money off of the money that they put in. And so there's that constant risk that needs to happen according to the system. And so because of that necessary risk, that means that the risk is still there. Bill Bradley says the falling rate of profit exists inherently in capitalism. Even if it's heavily regulated, there is no saving capitalism in the long term. Yeah. By the way, do you think that this is the beginning of a massive fallout? Let me know in the chat if you guys think that this is what's the start of, or we're starting something massive. Because right now, from what I'm seeing, it's 3 banks so far that have had that are, you know, basically going under. Is it going to be more? Because back when I think it was in 2007. Yeah, it was 2007. And I was watching the news, and I think it was Citigroup. Was it Citigroup that lost $19 billion? And I was sitting there. How old was I? Yeah, I was in my 20s. And I was like, how in the hell do you lose $19 billion? How? And they did. It's poof, like that. And I was like, what in the world are they doing? Come to find out, we found out what they did in 2008. And instead of actually, you know, punishing the people who put us at risk, what did the government do? Well, they said, it's okay. Here's some money. You guys will be all right. Colin says there was a recession after 9/11 at the start of the Iraq War invasion. So 2001 and 2003 as well. Thank you so much. Bill Bradley says, and if Obama had bailed out the people, the banks would have still gotten bailed out because people could have paid their mortgages. This is the point that I wanted to point out. But instead, they skipped the people and paid the banks. And the banks were still like, give me your money for your mortgage. Instead of paying the people so that they can pay their mortgage, they paid the banks directly. And the banks were like, thank you, government. Give me your mortgage. Oh, no. This is just for me from them. It's not. No, give me your mortgage. Oh, you don't? Okay, give me your house. So there's a lot of foreclosures. A lot of people lost their home. Even though the banks still made out like bandits. Janice Anderson says, doing everything they can to not call it a bailout. At this point, the banks should be made public. Public banking has proven to be stable for profit. More stable than for-profit banking model. And the thing is, that's what we need. We need stability. We don't need this risk. This risk is what is going to destroy us all. And capitalism is always playing chicken with our environment. It plays chicken with our health. It plays chicken with our, it plays chicken with our, our homes, our livelihood, our jobs, This system is like taping a whole bunch of steak and chops to your butt naked body, and you go out running among a pride full of hungry lions and hyenas, and you wonder why your ass gets bit. That's capitalism. You realize, look, you're literally trying to outrun a system like this, and then you're going to get bit. Why not get out of the enclosure? But they don't want to, because they want to risk it. Because they got to catch that dollar. Butt naked, running through. And Lady Gaga's meat dress. And this is why public banking is necessary, and postal banking. I'll put it like that. Postal banking. I see it's necessary. No more private banks. No. That's what I think. And people who are capitalists or capitalist sympathizers will look at me like I'm crazy. All right.
And this is 2018. Dodd-Frank was passed early in the Obama administration after the 2008 financial collapse. In 2018, they came back and revised it a bit. It raised the too big to fail threshold.
Revised it a bit. Is that what you want to call it? John King revised it. Oh, he revised it a bit. That what you want to call it? Like, okay, that's how, like having some Kool-Aid and you take half the Kool-Aid out and add more water, right? And you just revise it a bit, right? Or that's like having a bottle of ketchup, right? And you got a little bit of ketchup left, and then you pour some water in it and shake it up just to use it. Oh, you just revise the ketchup a little bit, right? Is that what we did? Or you got a little bit of milk left, but you don't have enough milk for cereal, so you take some of that milk, you put a little water back in it, shake it up, you revised it a little bit. Is that what it is? Is that what it is, John King? Is that what we call it now? Revising? You literally have the word behind you, John King. Rollback. That's probably a better word to use instead of revise. Let me tell you something. These corporate news stations, these corporate news media outlets, I'm telling you, they are always in favor for these people. They're always in favor for these corporations, for the big banks. I can't tell you how many times you'll see a Charles Schwab or JP Morgan or Chase Bank or some type of bank advertisement on CNN or MSNBC or Fox News. CNN brought to you by Charles Schwab. Talk to Chuck. It's the same thing. They get paid by them too. So what's the difference? Like, dear God, these guys, man. John King, stenographer for these financial institutions. Golly.
Threshold from 50 billion to 250 billion. Essentially, a lot of smaller and up to 250 billion. So you're talking medium-sized banks got exempted from the most stringent regulations.
So that was the point. They were exempt from the regulations. So because of that, they weren't being looked at closely. So guess what? They got off scot-free. Goodness gracious.
It exempted certain banks from stress test. Again, the smaller and medium banks. Eliminated so-called living wills for some banks. And ease some of the mortgage reporting requirements on these smaller and medium-sized banks. Again, this is a legacy. This is a reboot, if you will, after the 2008 financial crisis. It passed largely with Republican support. Republicans were pushing this, but 67 votes in the Senate, including 17 Democrats. 258 votes in the House, including 33 Democrats. So mostly Republicans, but a sizable number of Democrats. Now,
that's all.
the CEO of Silicon Valley Bank specifically lobbied for these reforms. This is Greg Becker. He says that bank, the one that just collapsed, didn't pose a systemic risk, and that imposing the requirements, the Dodd-Frank requirements, outsized burden on us. That was his argument. Now, Barney Frank, remember, liberal congressman from Massachusetts, he was the House sponsor, lead House sponsor of Dodd-Frank. He introduced it with Senator Chris Dodd of Connecticut. He joined the board of Signature Bank. That's the New York bank that New York had to take over the weekend in 2015. In 2018, he said, Barney Frank, who pushed the big Dodd-Frank, said the rollback does not in any way weaken the regulations. When he said that, he was on the board of Signature.
Y'all know what I'm about to say. Look, y'all already know. Y'all already know exactly what I'm about to say. The person that helped write that legislation went to work for a bank, to be on the board of a bank, and it's like, it's not really gonna matter that much. Now Signature Bank is also about to be bailed out, who Barney Frank was on the board of. So yes, that's the problem. Our government is bought and paid for, because even still, somebody like Barney Frank could leave government, retire from his seat in Congress, right? I think he was a senator. And then or was he a congressman? Either way, he retires from his seat and then he goes to work on the board of a bank. That shouldn't be legal, in my opinion. It's like, is this guy already got a pension for the rest of his life? He's good. He's good. And then he goes and works for the board of a bank. And then, because of the rollbacks, he's like, it's not going to be that big of a deal. 5 years later. So, Chuck lost money. This is from Fortune magazine. Charles Schwab's fortune, battered by Silicon Valley Bank, collapsed, with his wealth plunging more than any other American billionaire in 2023. What happened to Chuck? There's Chuck. All right. Billionaire brokerage founder Charles Schwab has seen his personal fortune plummet in the aftermath of Silicon Valley Bank's collapse over the weekend. According to the Bloomberg Billionaire Index, which monitors real-time wealth of the richest people on Earth, Schwab has personally lost around $3 billion in the wake of Silicon Valley Bank's failure. Schwab, who founded discount brokerage Charles Schwab Corp in 1971, now has a net worth of $9.99 billion, according to Bloomberg's estimate, making him the 183rd wealthiest person in the world. The Bloomberg Billionaires Index shows that Schwab's fortune fell by 7.7% on Monday, thanks to the brokerage's tumbling share price, a personal loss of $828 million. Since March 8th, Schwab has had $3 billion wiped from his net worth, according to the publication. Since the beginning of 2023, he has lost almost $3.5 billion, meaning his wealth has fallen more than any other American billionaire this year. Let me ask y'all something. Remember when Elon Musk asked the question, how much would it cost to end hunger? Was it ending hunger in the world? And I think they came back and said it would be like $6 billion. Charles Schwab literally could have liquefied those assets, that wealth, and then essentially fed half the world. And yet, because of him having investments, it poof, gone. Crazy how that works, right? Trust me, I'm not shedding any tears for Charles Schwab. As much as Charles Schwab's fortune is derived from a stake in his eponymous company where he serves as chairman, Charles Schwab dropped almost 12% on Monday. The collapse of SVB marked a massive sell-off in companies in the financial sector. At one point during Monday's trading session, shares were down more than 20%. Investors have been particularly fearful of firms like Charles Schwab, which have a large bond holdings with long maturities, might be forced to sell such assets at a loss to cover rush of deposit withdrawals, thus falling into the same trap as Silicon Valley Bank. If Charles Schwab goes under, I'm going to laugh. But not at the people who have their retirement accounts, especially just average workers. I'm not laughing at them, but I would laugh at Charles Schwab. I would laugh at him. Because not only did you lose $3.5 billion, but now your company's going under. Yeah. But at the cost of whom? It's going to be at the cost of workers. Talk to Chuck, they said. Chuck gotcha, he said. Dear God. So, yeah, that's what's going on right now. My goodness.